Yeah, can you hear me, Captain Amresh?
Loud and clear, loud and clear. Can hear and see you.
Yeah. Actually, my mic was not working, so I had to go back and join back.
Okay. No, it's loud and clear.
Yeah, and others, I have disabled the mic and the video for others. However, if you like, we can enable for everybody. But sometimes we have seen that it gets disturbing in between the.
Only the video you can enable, and
All right.
they can raise their hands, and we can unmute them accordingly.
Fine. See, anyway, they can send their questions in the chat. I have enabled the chat. Anybody can write in the box. I am anyway enabling the video also.
Yeah, can you just unmute Pratik also? Pratik is my team member, Pratik Saxena. Just unmute him. He will be taking care of the back-end work.
Pratik, okay. Okay, I'm making him so I have made him a co-host.
Yes, thank you.
Pratik
Thank you so much.
also a co-host now.
Pratik, you can put your camera on, and you are now co-host.
Thank you, sir. I'll do so, sir. Just 5 minutes.
We'll start dot at 3 p.m.
Yeah. And meanwhile, let me post a couple of polls so that I understand what kind of audience is there, what is the age group, whether people are sailing or people are in shore jobs. So I just want to understand the cohort, what kind of cohort we have right now.
Please, by all means, please.
Yeah.
Pratik, if you can just remind in all our group that the meeting has started so that they can join.
Sure, sir. I'm doing so. I'm doing so. Thank you.
That the meeting has started so that they can join. You are joining from SIP, Captain Pradhan. You are muted, sir. Can you unmute yourself?
He will not be able to unmute. Let me unmute everybody in that case.
Okay, okay.
Just hold on.
Just hold on, sir. The host is unmuting you.
Yeah, I have unmuted everybody, but I will just request everybody not to disturb in between unless you have a question towards the end.
Yeah. Yeah, Captain Pradhan, just thank you, sir, for joining. You're joining from ship, right, sir?
That's right, sir. You can see me in uniform, and thank you very much for organizing this much awaited one, sir.
Thank you so much. So, good afternoon, everyone. It's 3 p.m. and last Friday of the month, as usual, Seafarers Global Organization has been conducting the Maritime Leadership Talk Series for last 2 years, every Friday, last Friday of the month. And today, I'm very glad that someone from our fraternity who had started his career in shipping, but later on moved to finance, and today is a torch bearer in the industry when it comes to financial education. So good afternoon, everyone, and I'm a very warm welcome to all of you. On behalf of Seafarers Global Organization, I sincerely thank you for joining us today for this session on mastering personal finance, a subject that directly impacts not just our careers, but also our families and long-term well-being. As seafarers and maritime professionals, we focus heavily on health, safety, and professional competence. However, financial literacy often takes a back seat, even though it plays a crucial role in our overall stability and peace of mind. This session has been organized in response to repeated requests from our senior masters and mentees, and we hope it adds real value to your personal and professional lives. It is my pleasure to introduce our speaker for today, Mr. Mukul Malik. Mr. Malik is the co-founder and CEO of Asset Yogi, one of India's most trusted personal finance platforms, with over 4 million followers across digital media. Asset Yogi is widely known for its clear, unbiased, and research-based approach to financial education. Many of you may also know him as the host of the Asset Yogi show on NDTV Profit, and he was recently honored with the Finance Creator of the Year 2024 award by the government of Maharashtra, recognizing his contribution to financial literacy in India. What makes today's session especially relevant for us is Mr. Malik's maritime background. He is an alumnus of TS Chanakya, where he studied nautical science from 2000 to 2003 and later pursued finance at the Great Lakes Institute of Management in 2007 and 2008. This unique combination allows him to connect deeply with the financial challenge and realities faced by the seafarers. We are privileged to have him with us today, and I'm confident that this session will offer practical insights, clarity, and actionable learning. With that, I warmly invite Mr. Mukul Malik to take over the session. Thank you, and over to you, Mukul.
Thank you for all the kind words, Captain Amresh. I don't think I deserve that much of applause, but I'll try to meet your expectations of the maritime fraternity. I have stopped sailing since 2006, but I still am deeply connected with this fraternity. I generally go to most of the alumni meets, whatever happens in Delhi at least. Not able to go to the Mumbai meets quite often, but we'll try to whenever it happens next, the Dresha meets. But I am highly connected in my batch and senior junior groups. So I understand the current scenario also. And as you were also mentioning that the level of financial education is probably on lower side in this group, as I can understand while talking to a lot of my batchmates and other seniors and juniors. Right. So hopefully I'll try to do my best to educate people. Meanwhile, I will try to first gauge the kind of group that we have currently in this meeting. So I'm just floating a small poll. It's a 3-question poll. So if you guys can answer, and so that I will understand what kind of age group we are, what is our professional status, right? So I have just launched the poll. Please answer these 3 questions.
Yeah, while we will be answering this question, just to know everybody, this is also being live telecasted in Sailor Today YouTube channel. We are also recording this. So in case if there is some hiccups with Sailor Today YouTube channel live telecast, we can re-upload this again. It is basically requested by many seafarers who are working on ships right now because of the data limitation. They can't watch online right now, so that they will be able to watch at later stage. Please, everyone.
Yeah. So maybe a few more people can join till the time people are participating in this poll, right? So we can wait for 2 to 3 minutes, and then I will resume with my presentation. And once I will get the understanding of the group and what kind of understanding about investments is there in the group.
So before you start, Mukul, your presentation, I have few questions for you. And I think that will allow people also to kind of familiarize themselves with you, your background, and they will probably join by then. So just to understand that, since I am also from a spirituality background, the Asset Yogi name has very much it has really synchronized with my thought process as well. So what is the real story, if any, is behind Asset Yogi, or what determined you to choose finance and why Asset Yogi?
Yeah, see, yoga, as we understand in our Hindu spirituality, is basically a combination of body and mind also plays a big role, right? So whenever we perform any activity, and as long as we can keep our mind calm, so that becomes a yogi, if that person can do that, right? So similarly, if somebody can do the investments and build assets with a calm mind without moving as per the volatility of the markets, then that becomes a asset yogi. So it is not necessarily me. It is anybody who performs asset building, right? As just like a mind of a yogi, then that person becomes asset yogi. So hence the name. So anybody who performs asset building like a yogi is an asset yogi.
Thank you so much, Captain Pradhan. It is in the topmost. If you see, there is a graph. You can just see there, and you can participate in the poll. Thank you so much, Mukul. And also, since you are all from the Chanakya and we have a great association with Chanakya, we keep visiting them. I'm sure IMU may have joined. I have shared this invitation to Vice Chancellor of IMU, Malini ma'am, and also the directors. Either they will watch, or if there is an exam, they will watch you later on. And being alumnus of Chanakya and Seafarers, I just want you to highlight some of your experience as what you have learned, or whatever leadership learning that you had during your sailing days, and whatever you would like to convey to present generation of sailors.
Okay. Can I answer that after the presentation?
You can. So over to you then. Over to you. We have 30 already. You can.
I will definitely answer that towards the end because I think people have joined this presentation webinar for a reason, and I don't want people to wait any further. And let me just start by, in fact, I think I have received a couple of questions from you guys. These are very basic questions, and from the polls I can understand there are a lot of people in 20s who have joined, right? That's the biggest group that we have currently, but at the same time, it's quite a diversified group. We also have people in their 40s and 50s, right? So I will try to balance the presentation, and I will try to, in fact, through my presentation, you will probably understand that, it's not just for beginners. It is also for people who have been investing. And I conduct this webinar for a lot of people, and generally for experienced investors also, we get this feedback that they get value. So I will request that you guys please give me next 1.5 hours. Please don't drop in between. I will make your time worthwhile, right? Now, next is what is your professional status? Most of the people are sailing, right? Somebody has said about to start sailing, and 2-3 people are from shore jobs also. What is your level of investment activity? So most of the people have said that either they don't have a clue or they are doing it without a plan, right? Some people are saying, very few are saying that they have a proper plan. So hence the financial literacy becomes very important, right? So I think I can gauge the overall pulse of this group, and probably this is a subset of the larger maritime group, right? So I think this will eventually help a lot of others who will get access to this video in future also. Now, so let me share my screen with you, and just let me know if you are able to get this. Can you see my screen? Can you just give me a hands up?
Yes, we can see your screen.
All right, so it's a blank screen. All right. So let me start with very basic. So what is the basis of financial planning? See, first is that we want to help ourselves and our family, right? So as a thumb rule, first that we have to plan for is insurance, right? So whenever we are doing any kind of financial planning, whether you are a beginner, whether you are in your 30s, 40s, if you have not done your health insurance or life insurance, you should do that first, right? And in the insurance, you have to take health insurance first, and then comes your term life insurance, right? I'm writing this clearly, term life insurance. A lot of people get, these endowment plans or regular life insurance plans from LIC. These are not good. Why? Because you don't get good returns in these kind of plans. On an average, the returns are 5 to 6%. I have tested this last 25 years, 30 years, and the returns are not more than 6% anytime, right? So people generally get attracted to the payback. Okay, I'm investing, let's say 50,000 every year, and at the end of it, I'm going to deposit, let's say 1 crore, but I'm getting 3 crores. But if you understand, if you're going to invest the same amount in mutual funds or stocks or somewhere else, you will get much better returns, and that corpus will not be 3 crores. It is going to be probably 10 crores, right? So that's the kind of difference we are talking about. And 3 crores versus 10 crores in today's terms, you can judge yourself what kind of lifestyle difference it can make. Number one, right? So first step, we have to take our insurance, health insurance and term life insurance. Second step, we have to plan for emergencies. We have to plan for emergency fund. So which basically means this will take care of our emergencies like job loss, right? Job loss or income loss. Maybe you have certain level of income in your family, and tomorrow your father is getting retired, or you probably lose your job. Anybody from your family loses the job. There will be a drop in the family income. We have to plan for these kind of emergencies. Similarly, there can be a medical emergency in any family, right? So how do we plan for this emergency fund? Generally, as a thumb rule, 6 months of our income can be our emergency fund. We will start investing after these 2 steps are done, right? Third step is investing for long term, right? Investing for long term. Now, this investing can cater to your retirement, can cater to your different kinds of goals. Maybe you want to do an MBA 5 years down the line. Maybe you want to, send your kids to some foreign university. Maybe you are planning for a vacation after 3 years, 4 years. Maybe you want to buy a house, a car after a few years. So these are the different kinds of goals that can be taken care by investing. And then this investing can also take care of short-term and medium-term goals also, right? But broadly, we invest for the long term, right? So these are the 3 steps of financial planning broadly, right? Now, we will be focusing on this more because this is probably a topic where not many people are clear how to invest for short term or long term, which products are better. right? So I'm going to give you a glimpse of all the products, what kind of returns we can expect, and what are the historical returns that a particular asset has given, so that we get the exact comparison, right? So I'm going to stop sharing this one, and I'm going to share the other slide with you now. So far, any questions about the financial planning?
No question right now. If there is anything, we will ask you.
Yeah, so please, you can note down your questions and we can take them towards the end, right? Just hold on. I will have to stop this one. Just
No,
bear with.
we can see your presentation. We could see your presentation.
Okay, just hold on. I was not able to see my presentation, so
Oh,
that's
okay,
why.
okay.
Let me share this again. Yeah, can you see the presentation now?
Yes, we can.
All right, I can see some reactions. Okay, let me start with this. I think most of you have seen this mutual fund Sahi Hai campaign, right? So what we say is at Asset Yogi Wealth that research-based investing ज़्यादा सही है. And I'm going to prove it to you with data why research-based investing ज़्यादा सही है, right? Now, where Indians are investing right now, this is all data, right? Just a sec. Yeah. So if we see, so out of 100% of the net worth of a typical Indian, 51% is generally invested in real estate, 15% in gold, and 13% in fixed deposits. Mutual funds and shares are about 6%. Now, this data was about 2% till 2019. There is a big surge in mutual funds and shares after COVID. And I think that is a good thing that has happened in the country. Now people are more aware about equities and share market and mutual funds and so on. Now let me also give a perspective of how developed countries are in investing. This number is about 40% in USA. And I think we are heading towards this number, if not 40%, maybe 20%, 25% in coming 10-15 years. And this others comprises of all kinds of small saving schemes like, Sukanya Samriddhi Yojana, Public Provident Fund, EPF, and others, right? But this trend is changing. People are getting more aware about mutual funds and shares, and probably for the right reason, because returns are much higher here. Of course, there is a higher risk as well, but that is what we have to balance, right? Now, here I'm giving you a proper comparison of all the assets. Now, I'm not saying that you have to only invest in mutual funds and shares. Every asset class has a different reason in your portfolio, right? For example, fixed deposits, on an average, they give about 6% returns. This is actual data of last 20 years, right? So in last 20 years, average returns of fixed deposits are about 6%. But if you see, real rate of return is probably negative because there is also inflation. Inflation means mehengai, right? So generally you see that 5 to 6% inflation is also there. So real return that you're making in fixed deposits is only 0%. So you are not really making any money, right? So fixed deposits, still, they should have some portion in your portfolio. What kind of portion they can have, that you can decide. Basically, as I said, emergency fund you have to plan, right? Your emergency fund can be in your fixed deposits or in debt liquid funds, which are mutual funds. They are highly liquid. You can take them out anytime, whenever you want it. Now, if you have a goal, if you need money for less than 2 years, right? So for example, you want to buy a car next year. Should you be investing that money in mutual funds or stocks? No, absolutely not. You need that money, and probably after 1 year, the stock market is not, performing well, and you are probably making a loss in the short term. So you should not keep that money in fixed deposits. So less than 2 year, any goal, you should be keeping that money in fixed deposits or highly liquid funds. So liquidity is very high in fixed deposits. Risk is very low. You can straight away go to a bank, and these days you can open your FDs online as well. Skill and effort is low. Obviously, it is very easy to open a FD account, but it doesn't beat inflation. So whenever we are investing, this becomes very important that we have to beat inflation if we are not making real returns. What is real return? Let me write it here. Real return is equal to returns that you are getting, right, minus inflation. So if this real return is zero, that means you are not making any money in that investment. Now, next comes is real estate. In real estate, on an average, you get about 7 to 8%, and this is the data of metro cities in India for a residential real estate. Generally, retail investors are not so investment savvy that they can invest in commercial real estate so easily. Most of the people generally invest in real estate, and hence I have mentioned those returns here. Here, you can generally assume that you can get probably about 4 to 5% of capital appreciation and 2 to 3% of rental returns. So on higher side, even if I take 5% of capital appreciation and 3% of rental return, you get only 8% of returns. But real returns will be about 1.5% to 2% only, because inflation is also about 6%. This is a long-term average, right? Here, liquidity is low, which means you cannot sell the real estate as and when you want it. If you have to really do the distress sale, then probably you will have to accept a lower price. Hence, it is very difficult to sell real estate when you really need the money. Risk is medium. I'm not saying it is high. I'm not saying it is low. It is not as low as FD, but it is not as high as stocks. Of course, there is some level of risk. Suppose you have a tenant in your property and he's not vacating on time. That's a risk, right? When you are purchasing a real estate and you are not doing the due diligence properly, and in India, we all know that, there can be a lot of jhol-jhal in documentation. So that's a risk. So we have to manage that risk. Hence, the risk is medium. Skill and effort required is also medium. It's not that you can purchase real estate at the click of a button. You still have to scout properties. You have to search for right properties. It will take up probably 3 months, 4 months, 5 months. It's a lengthy process. And at the same time, when you're managing your real estate, it's not that it is 100% passive income. It's not 100% passive income. You are still, I am also managing some real estate. So I understand, whenever we have tenants, some tenant is not vacating on time, and it's a headache, right? It barely beats inflation. So a lot of you will be investing in real estate, and yes, of course, you should have your house. I never say that, you should not have your house. You should definitely invest in your house. That can be one of your goals, which you can meet through other investments also. But managing real estate as an investment is a real task that you should understand. It is not passive income as most of the people understand it to be. It is active income. You have to manage your property. And I have managed real estate in the past. I know this for sure that, it really requires effort. Now, next is gold. Gold is very interesting now. Gold has given about 12%. In fact, if you will see, it is probably 15% now, if you will calculate it in last 20 years. But there is a, anomaly here. In last 1.5 years, gold has given phenomenal returns. It has more than doubled, right? So hence the data that you are getting is skewed. On an average, if you remove last 1.5 years, the returns that you get from gold is 7 to 8%. Internationally also, if you will see, gold generally, real return that you get from gold is about 1.5 to 2%, which is in the range of real estate only. So after subtracting the inflation, the real return that you get from gold is 1.5 to 2%, right? Liquidity is medium, as in when you really want to sell your physical gold, you have to, go to a jeweler or somewhere else, and hence liquidity is the medium. It is not like FD, but it is not highly liquid like stocks. I mean, liquidity is very high in FDs and mutual funds and stocks, but it is not like real estate, as low as it is not very low like real estate. So hence it is medium. Risk is also medium here because see, when you are investing in physical gold, you are paying GST, you are paying making charges, plus when you are going to sell to the whenever there is a selling moment, you are going to sell to the jeweler and he's going to charge a spread. So even if you are investing in gold, the better way of investing in gold is ETFs. There are exchange traded funds which are traded on markets. You can buy those gold ETFs and they are highly liquid. In physical gold, you will generally lose out on GST, making charges and spread. Here, skill and effort is low. You don't need a lot of research in investing in gold. All you need is just some understanding of the market, where the markets are headed. That's all. It, yes, sometimes beats inflation. This is very cyclical. So whenever stock markets are not doing well, at that time, gold generally does well, and all the commodities and metals, they do generally well. Next is shares and mutual funds. Let me cover them together. In shares, you can expect about 16% returns. So on an average, last 20-25 years, we have got about 16% returns in shares, and mutual funds about 14%. Liquidity is very high. Whenever you want your money, you can sell your shares, you can sell your mutual funds, and you can, basically realize your goal, whatever goal that you have planned for. Suppose the event has come, your kid's marriage is already at your doorstep, right? And then you can quickly redeem your mutual funds or stocks. Now, risk is slightly on higher side when you are investing in stocks. In mutual funds, I am saying medium because risk is diversified. Any mutual fund today owns minimum 40-50 stocks. So your risk is spread out. So with diversification, it is proven that risk is reduced. There is a Nobel Prize winner, he's called Markowitz. He had proven that if you are investing in about 30 stocks, right, then your risk is reduced and your risk adjusted returns are maximized. So it is proven with science that risk gets reduced with diversification. Skill and effort in terms of shares is high because there are so many listed companies. You have to do a lot of analysis, fundamental analysis, technical analysis to invest in shares. Plus at the same time, you also have to check them regularly. Here, mutual funds, you can do passive investing also. These days, you can do SIPs, right? And I mean, not from these days. I was doing SIPs in probably 2004-05 also, when I had started investing. So SIP is basically systematic investment plan. Every month, the money gets deducted from your account automatically. You can just start investing and you can forget about it. Even if you are selling, the money can get deducted from your account monthly. So this is a beautiful way of investing, because even if markets are down and let's say our goal is 10 years down the line, 15 years down the line, our acquisition cost is averaged out, right? So even if markets are not performing for 1 year, 1.5 years, your cost of acquisition is at least low, right? So this is a beautiful way of investing. I have tested SIPs, back tested them last 20-25 years. 95% of the times SIPs win. Very few times lump sum investing can win. Let me write lump sum also. Lump sum also we can invest, right? So lump sum wins only when markets are down relatively, right? So only then lump sum investing starts making sense. Now the main point why we were discussing all these assets was real return, how much we are making. So these two asset classes beat the inflation by a wide margin. So you can beat the inflation by almost 7-8% easily with the mutual funds and shares. But is it going to happen every year? No. because sometimes the markets may not perform for a good 1 to 2 years, right? So during that time, your returns may be slightly on lower side. However, markets over a period of time, over a period of 5 years, 6 years, 10 years, whenever we are talking about more than 5 years, markets generally beat inflation. In fact, I have tested this also for last 25 years, 30 years, 40 years. You take any 5-year period. In that 5-year period, returns are generally inflation beating. And if you give sufficient time, if you are giving more than 10 years, then for sure you are beating the inflation by a wide margin. So I wanted to spend a little more time on this slide so that we have the right context. Now I will be focusing more on shares and mutual funds because this is where the real investment planning works. Now let's understand what kind of difference this can make in 10 years. The same investment, suppose somebody has invested 10 lakhs in FDs versus real estate versus gold versus mutual funds versus shares. This is the amount that you can expect after 10 years. So you can clearly see that mutual funds and shares beat the other asset classes by a wide margin. Now, why invest in shares and mutual funds? Because our GDP is growing. Our country is growing. We are in a developing country and India is the fastest growing developing economy or the largest economy amongst the large economies. It is the fastest growing, and this year we are projected to grow at 7.4% real GDP growth. So if we add inflation to it, then we can expect 12% of growth. So if our country is growing at 12%, why should stock market will not grow? Our stock market will also grow probably more than this because that's an organized market. Now, why invest in India? When we are investing in stock markets or mutual funds, we are actually investing in our business growth and we are actually investing in India. What are the near-term catalysts? If you see latest numbers of inflation, our inflation is also at all-time low almost, right? In November, let me write the figures here. In November, it was about 0.3%. In December, it is about 1.3%. What does this mean for an investor? It means that if inflation is less, that means we are getting more money in our hands, then we can invest more and we can purchase more. If we are going to purchase more, that means our businesses are going to grow more. So we should be investing in our businesses when inflation is less. Similarly, whenever there are rate cuts, rate cut means interest rates. Let me write here, interest percentage. So if you see in last 1 year, there has been almost 1% interest rate cut by RBI, right? So again, whenever interest rates are cut, that means we are getting more money, we can purchase more, we can invest more. So our businesses are going to grow more, our stocks are going to grow more, right? And at the same time, there is also a drawback here. When interest rates are cut, FD interest rates are also going to go down, right? You would have seen your FD rates go down in last 1 year. So when we were getting about 7% of FD interest rates, probably in January of last year, this year, we are not getting more than 6%, right? So interest rates will have a effect on both your loan as well as on your FDs. Then we also had GST cuts, right? So in fact, a lot of auto companies have started doing well because a lot of cars have suddenly become much cheaper. So this will get reflected in the net profits of our companies. So net profits growing means our stocks growing. Income tax relief also happened. We saw that in new tax regime, the slabs are reduced and up to 12.5 lakhs of income, there is no income tax. And in fact, I think this is not very relevant to our maritime fraternity because anyway, your income is tax-free. But now I'm on the other side and I am paying taxes. It is relevant to me. Now, pay commission is also coming up this year, right? So if government employees are going to get more money in their hands, that means the consumption will grow and our business will grow. So these are the near-term catalysts why I am slightly bullish on our markets, on our domestic markets. Now, why long-term investing wins? This is an example of a typical 10,000 SIP. SIP is our systematic investment plan that we do in our mutual funds. So suppose somebody had invested 10,000 rupees from January 2008 to October 2008. If you notice, I am taking the peak of the markets. See, all of you must remember that there was a recession in 2008. So what happened was markets were at the peak in 2008, Jan 2008. Let me write here, Jan 08, right? And then there was a bottom in October 2008, right? So if somebody had been investing 10,000 every month here, so his portfolio had come down in the short term by about 37%. So what he should do here? Should he take out all that money at 37% loss? No, actually speaking, his cost of acquisition is now very less, right? Now the same amount, if he was investing from January, let's say he was investing at the peak and he kept investing, right? Let me extend this timeline. Let's say he kept investing till 2025. This investment would have grown by leaps and bounds. What is this investment going to be? His investment, let's say he was investing 10,000 every month, then total investment amount was about 20 lakh 40,000. This will become 66 lakh 49,000, which is 12.63% per year. So at the end of the day, he was winning. But winning when? When he is investing in the long term. So no matter what investment cycle you are starting at, as long as you are investing for the long term, you are going to make money. Let me give you another example here. Let me just charge my laptop. Sorry for the inconvenience here. There is a battery down indication. Yeah. So let's say somebody had started investing at the peak before COVID, right? I'm giving you one more example here. Let's say somebody was starting at January 2020, and again we know that markets were at peak, and in March there was a downturn because of COVID. All of us have experienced this, right? And a lot of portfolios were almost 25 to 30% down. And you can see here also, this person would have invested about 30,000 rupees and his portfolio would be down to 22,000 rupees. So a loss of about 26% in just 3 months. But if he's investing continuously, and let's say he had invested till January 2025, his total investment amount would have become 6 lakhs. And at the end of January 2025, this investment amount will become almost 9 lakhs, which means 16.17% per year. Again, proving that whenever you are investing for the long term, no matter, even if you are starting at the peak, this person was starting at the peak, but still his returns have become 16.17% per year in the long term. This was a 5-year period only. Now, how should we invest? So what generally any financial expert will suggest you is that we should be doing goal-based investing. What is goal-based investing? We have to divide our goals in short term, medium term, and long term. But whenever we are, thinking in 3 variables, then we have to plan for 3 variables. So what at Asset Yogi Wealth we do is that we generally define short to medium term as one bracket and long term as one bracket. So any goal that is less than 4 years will fall into short to medium term. Here, capital safety becomes more important because there is high volatility in stock markets, right? The markets are going like this, like this, like this. Yes, over the long term, you start here and you will end up here. But let's say if you start here and after 1 year, this market can go down also, or it can remain flat also, right? So hence, when we are talking about the short term, 0 to 4 years, capital safety becomes more important. And of course, growth will also be moderate because the choice of products will be very different here. Since capital safety is important here we choose debt funds and we can choose equity funds. we can have a combination here. Suppose there is a goal of 3 years, then maybe we can have a hybrid fund, or we can have a combination of debt and equity funds. So depending on the goal, we can suggest debt funds or equity funds, or you can also choose yourself what kind of funds you want to invest in. So examples of short to medium goals can be, you are probably building your emergency fund like I spoke, right? Then probably you want to buy a car after 2 years, 3 years. Maybe you are planning a vacation after 1.5 years. So these are the kind of goals that you are planning for in the short to medium term. Long-term goals are generally 4+ years. Here you are seeking higher growth. By higher growth means that we are seeking, let's say, 13% plus returns, right? And which are possible through mutual funds and shares. Through these, we can plan for our retirement. We can probably plan for buying a house, child's education, child's marriage. These are some of the goals that generally people have in the long term. Here, equity funds will play a large role, and at the same time, you can have some portion of stocks in your portfolio. I'm going to talk about how you can build your mutual fund portfolio and stocks portfolio, right? Now, why goal-based investing helps? It first of all builds your investment discipline. Once you have bifurcated your goals in short to medium term and long term, then you really know how much I have to save or invest to reach that goal. You will exactly know. Let's say, I'm just giving you an example. Let's say you need 10 lakhs after 3 years, right? So you exactly know that this is my final output. I want to buy a 10 lakh worth of car, or I want to go for a foreign vacation, which is going to, cost me about 10 lakhs. So you exactly know the amount, you exactly know the time frame, you can back calculate, and there are a lot of calculators available. We also have a lot of free calculators. You can use them. You will exactly know how much I have to invest monthly and how much probably I have to invest lump sum, so that the amount becomes 10 lakhs after 3 years. So you will have good investment discipline that way. It will also avoid FOMO buying and panic selling. Generally, how people are investing in India, a lot of people are entering in the market when markets are at all-time high. Let's say people are entering here, right? Now, today, in fact, let me give you an example of gold and silver. Yesterday, gold was at peak, right? It hit about 1,80,000 rupees per 10 gram. Silver was at all-time high, 4,20,000 per kg. So now a lot of people have this fear of missing out. And you should not be investing in any asset class because of FOMO, right? Because you will end up taking the wrong decisions. And what will happen is, if you're only buying because of FOMO, most likely this will fall here and you are going to exit here. So what you're really doing is you are making a loss here, right? And this is happening. The data says this. There are a lot of DIY investors today who are not even continuing with their SIPs for 1 year. In fact, almost 50% Gen Z investors have quit their SIPs in less than 1 year. So this is bad behavior, bad investment behavior, right? So we also can identify our risk appetite when we are planning with our goals in mind, right? You will exactly know how much risk I can take in the short to medium term and how much risk I can take in the long term. You can clearly set your time horizons to your goals. As I gave this example, you will exactly know that after 3 years, I will need 10 lakhs. Now, why is goal-based investing important? I am giving here few examples because there is inflation. A lot of people feel that inflation is just 5 to 6%, whereas education inflation is more than 8%. Here I have taken only 8%. If you see the data, it is probably 10 to 12% in last 5 to 10 years. Just imagine the cost of MBA, what it used to cost 10 years back and what it is costing today. You will know for yourself what is the education inflation we are talking about. But I have taken a conservative figure here at 8%. Even if the education inflation is at 8% in 20 years, the same MBA that is costing about 25 lakhs today, it is going to cost about 1.16 crores after 20 years. And now people will say that, oh, this is very unrealistic. But 25 lakhs was also unrealistic 20 years back. I could not imagine doing my MBA at 25 lakhs 20 years back. But this is happening today, right? So we will have to imagine this number for sure because there is inflation happening. Now, can we have this number if suppose somebody is investing, how much we have taken? 10,000 per month. Suppose somebody is investing 10,000 per month and he wants to get this amount after 20 years. Is it possible using FDs or real estate or gold? Probably not. These are the kind of amounts that you can expect after 20 years by investing 10,000 per month, right? However, through shares and mutual funds, this is possible. So basically what we are saying is that whatever goal that you want to meet, this is possible with a lesser investment because here you can get slightly higher returns, inflation beating returns. One more example. So suppose somebody has taken a home loan and he is also doing a parallel SIP of 10,000 per month. Then he can prepay his home loan much faster. I'm giving an example here. Let's say somebody has taken a home loan of 50 lakhs for 20 years at 8% interest rate. What is going to be his EMI? It is going to be about 41,822 per month. So 20-year outflow is going to be about 1 crore. So what is happening is he is paying the principal of 50 lakhs plus he's also paying interest of 50 lakhs in next 20 years. Now, let's say he's also running a SIP of 10,000 per month and here he is generating a higher rate of return. So what he can do is after 11.5 years, his corpus in the SIP, mutual fund SIP will become 31 lakhs. So here his outstanding loan is also 31 lakhs. So he can repay this 31 lakhs. So what is going to happen is he's going to pay after 13 years, he's going to pay about 89 lakhs. This is not 13 years. This is actually 11.5 years. So after 11.5 years, he's going to pay about 89 lakhs, which means that he is going to save 11 lakhs in interest, right? He was paying 1 crore here. When he was paying normal EMI, then he was paying almost 1 crore here. Now here, first of all, he's saving 11 lakh on interest. And at the same time, he is also getting debt-free 8.5 years sooner, which means for these 8.5 years, he can now invest how much? He can first of all invest this EMI also because this EMI is also paid off. Plus, he can continue investing this 10,000 SIP also. So this will become 51,822 per month. He can keep investing this much amount. Now he is debt-free and much faster. So this is the effect of investing in SIPs. Now, the next question is how to build a mutual fund portfolio. Now, most of the people, what they do is they just do the first step, which is screening and shortlisting. And how generally people do this screening and shortlisting? They will go to their app like Grow or Zerodha, Coin or Kuvera, Scriptbox. There are a lot of apps these days, right? So they will see which fund has given the maximum returns in last 5 years, 3 years, and so on. But please understand that past returns are not equal to future returns. Probably, let's say a defense. Let me just give you an example, a real example. Defense portfolio has given, let's say, 25% year-on-year returns in last 4 years. Is it going to give the same amount of returns in next 4 years? Probably not, because these companies, these defense companies have become very expensive now, right? So you have to check the valuations of that fund. But is anybody checking those valuations? Today, I can tell you that in sectoral funds, we have highest amount of AUM. AUM is our asset under management. We have more than 5 lakh crore. This is the highest AUM of any sector. This is more than large cap, mid cap, small cap. People are investing in highly risky sectoral funds these days. This is alarming, right? So this way of screening and shortlisting is not right. So we have to do a proper quantitative and qualitative analysis. Then second step is allocation. Let's say you have chosen 4 mutual funds for investing. Should the ratio be 25% each? No, not necessarily. You have to check the markets. It should be based on what is your portfolio size. Maybe if you are investing only 10,000 per month, then probably 2 mutual funds are also enough, right? It is also based on your risk appetite. Should you be investing in sectoral funds? Should you be investing more in momentum funds? Should you be investing more in large cap funds? So you have to balance out your portfolio properly. It is also based on your investment horizon. As I have spoken earlier also, that in the short to medium term, we have to invest slightly more in debt funds and slightly less in equity funds. So this allocation is also a key. And there is proper data which suggests that you can create better returns just by proper allocation also. Now, this allocation, let's say in 4 funds, 1, 2, 3, 4, you have chosen, let's say 30% here and 20% here and 35% here and 15% in the 4th fund. So should this remain same for next 10 years? No, this will also change. So this change means rebalancing. So every year we have to look at our portfolio and we have to rebalance, right? So how this rebalancing is done? This is based on market conditions. Should we be investing more in debt funds right now? Should we be investing more in equity funds right now? If we have to invest more in equity funds, then should I invest more in small cap now? Or should I invest more in momentum fund now? What kind of fund should I be investing more in? That is rebalancing. Now, why this is important? Because one wrong choice can hurt. This is an example of a momentum fund versus a value fund. So from January 2021 to January 2024, this momentum fund, these are actual data. I can't name these funds because then it will become some kind of a recommendation and I can't make recommendation publicly. Now, this momentum fund had given about 44% year-on-year returns during this period, and this value fund had given about 28%. Obviously, this fund was winning in this period. However, in July 24 to July 25 period, this was exactly opposite. This momentum fund was actually giving losses, and this value fund gave about 10.4% return. So I'm not saying that you should have chosen momentum fund or you should have chosen the value fund. However, if you are rebalancing the right way, you could have moved from momentum fund to value fund during this period. And this can be judged based on various parameters. Now, this is also a real portfolio of one of our clients, right? So this person is doing 15,000 of SIP in 15 mutual funds. So what is happening here? He is doing 1,000 rupees per month in each of the 15 funds. So what is happening is this diversification good? A lot of people think that, if I will have a lot of mutual funds in my portfolio, then nothing will go wrong. But this is actually diversification. You are diversifying your portfolio. Now, let me give you the proper dissection of this portfolio. You can see HDFC Bank in almost every fund, right? In the top funds. You can also see a lot of repetition here. ICICI Bank, ICICI Bank, ICICI Bank, right? Then you can also see Infosys in multiple stocks, in multiple funds, Infosys. So there is a lot of repetition. So here, what is happening is his portfolio is highly concentrated, not diversified. 55% is actually invested in banking and finance, and 15% is invested in IT sector today. So this is not real diversification. So how do you do real diversification? For that, you must do a proper correlation analysis. How much is what kind of stocks that fund is investing in? You will have to look at them. And here I am only talking about sector. What about small cap, mid cap, and large cap? So there has to be a proper diversification. So mutual fund and shortlisting. Now I'm going step by step how mutual fund and screening and shortlisting can happen. Today, there are 1800 plus mutual fund schemes across categories, and we can shortlist 2 to 5 funds for our allocation, depending on the amount that you want to invest in. Let's say you are investing only 10,000 per month, then probably 2 funds are also enough. However, if you are investing, let's say 50,000 per month, then probably you can look at 4 funds also. That is also fine. Now, how do you screen? There are a lot of parameters. I mean, a professional can definitely look at 30-40 parameters, but a retail investor should be looking at minimum 4 to 5 factors whenever he is looking at the mutual funds. So these are some of the screening factors. What is the fund age, standard deviation? Standard deviation is our risk profile. I mean, we can judge risk based on a couple of parameters. These are risk parameters, standard deviation. What is standard deviation, right? In fact, I'm going to explain standard deviation slightly in more detail. What is alpha, correlation, capture ratios, portfolio turnover, Sharpe ratio? I'm going to explain 3 or 4 ratios here. First is simple alpha. So whenever you are looking at any mutual fund, you should look at this number. So for example, if Nifty 50 is our stock market index of the top 50 companies, top 50 listed companies. So you can get all this data from a lot of portals. A lot of portals are available, right? There is a portal called screener.in. You can, let me write it here. Screener, it's a very popular portal. You can get all this data, right? What is Nifty 50, how Nifty 50 has performed over the years. Then you can also look at your fund returns, which are, if this a particular fund, whatever that you are judging has given about 14% in that particular year, that means 14 minus 10 is 4%. This has given 4% or more returns than Nifty 50, than the index. So every fund follows a particular index. There is a proper strategy that the fund manager lists for himself. So you have to judge this number. You have to see this number, whether that fund is beating the index or not. Second is beta. What is beta? Beta, let me explain on a graph here. Let's say index is moving like this, right? Let's say this is Nifty 50. Nifty 50. And if a stock is moving like this, whenever Nifty moves up, this moves more than Nifty. And whenever Nifty moves down, it moves more than Nifty again. This is called as a high beta stock. If a stock is moving along with the index, that means the beta is 1, right? If this is more than 1, that means it is going to have better returns when Nifty is moving up. However, it is going to have more losses. This will be a loss, right? If Nifty is going down. So if beta is less than 1, that means risk is higher than market. If beta is equal to 1, that means risk is equal to market. If beta is less than 1, that means risk is less than market. So this beta number will be available. You don't have to really calculate it, but this will be available for every mutual fund. You can have a look at this beta. Next is standard deviation. What is standard deviation? Again, let me explain it on a graph. Let's say Nifty is moving like this, or any index is moving like this, and any particular investment or any particular fund is moving like this, like this. This means higher volatility, right? So whenever, in fact, let me give you an extreme example. This will be a graph for crypto, right? You know that crypto can move by 50% in 1 month itself. That means it can move really very high. It can move really very low the next month. So whenever we have a high range of volatility, that means standard deviation is very high and risk is very high. So this is also a risk parameter. So standard deviation also you can get for every fund. But a better ratio to capture is Sharpe ratio. What is our objective? So basically our objective is that risk adjusted return should be maximized. So whenever any fund manager is showing you better returns, is he taking very high risk? If he is taking very high risk, that means Whenever the market is going to go down or they are going to become flattish, that means your portfolio is going to go down more drastically. So this can be judged with Sharpe ratio. So Sharpe ratio, the formula is written here. You don't have to really calculate it, but for the nerds, it is still written. Fund return minus risk-free return. What is risk-free return? It is the risk-free return of treasury bills. So treasury bills are our short-term government bonds. So this is also available on RBI website. So let's say fund return is 12% and risk-free rate that we can take is 6% these days. So this becomes 6% in the numerator divided by, if 10% is the standard deviation of the fund, that means Sharpe ratio is 0.6. Now, what does this mean? This you have to compare between different funds. When you are comparing, let's say 4 funds in the same genre, let's say you are comparing small cap fund 1, small cap fund 2, small cap fund 3, and small cap fund 4. Let's say here Sharpe ratio is 0.6, here it is 0.5, here it is 0.8, here probably it is 1. So clearly this is a better Sharpe ratio. Sorry. What we want to do is we want to maximize the Sharpe ratio. So clearly, whenever Sharpe ratio is maximized, that means our risk adjusted returns are maximized. So we can go for this fund, right? This is how you can look at the funds. So these are few of the parameters that you can judge. Now, second step is our mutual fund allocation. So suppose you have 5 funds and you want to allocate them. So what we do is a professional can run a lot of simulation models. We have a lot of Excel based and AI based simulation models. So based on the past performance of a fund and the current market condition, we can do the allocation. So fund 1 will have probably 20% and fund 2 15% and so on. So we will assign these weightages as per the simulation model. However, if you're doing it for yourself, at least you can look at the valuations. What are the valuations these days? How do you judge the valuation? You can look at the PE ratios. PE ratios are price earning ratios. Price earning. I know for some of you, this is becoming slightly technical, but I just want to make you aware. You can, look at these numbers later on also, and you can, have better learning. And at the same time, if you're looking at some professional help, we are also there to help. Now, as a DIY investor, you can look at the price earning ratios of a particular fund. And if it is more than the historical, let's say on the historical, then that means you can reduce your weightage in that particular fund, right? If it is less than historical weightage, that means you can probably increase some weightage in that particular fund, right? So this can be done by a DIY investor also. And how do you get this P? This PE ratio for every fund, it is available in the fund sheet or the information memorandum. Every fund has a information memorandum, and you can compare this with, let's say, Nifty 50 or the index value. You will compare this fund PE with PE of index. Right? Now, third point is mutual fund portfolio rebalancing. How do you rebalance? Just a sec. So rebalancing means that you are going to reduce some weightages in some fund and you are going to increase weightage in some other fund. That can be based on multiple factors. It can be market valuations based, it can be fund performance based, it can be based on the risk. If there is a change in the manager or is there a change in the strategy of the fund, there can be macro shifts, whether, some funds are performing better in current economic cycle or some fund can perform better in another kind of economic cycle. It can also be based on tax and cost consideration. So there is long-term capital gains tax and short-term capital gains tax. Long-term capital gains tax happens when you sell your funds or your investments in less than 1 year. Short-term capital gains tax happens when you are, sorry, I have written it opposite. When you are selling after, and short-term capital gains tax happens when you are selling your funds in less than 1 year. Long-term capital gains tax is at about 12.5% right now, and this is 20%. So we want to reduce this tax. If you are going to sell your mutual funds just in 6 months, then it is going to attract a higher tax. So we want to avoid this higher tax. So we want to minimize our tax also whenever we are doing any rebalancing. And there is also an exit load. If you are going to sell in less than 1 year, most of the funds will attract exit load of 1 to 2%. So you don't want to lose on that also. So whenever we are rebalancing, we also have to take care of tax and costs. So how does this rebalancing look like, right? For example, in fund 1, you have, let's say you have invested in 4 funds. You are doing 4 SIPs in year 1. Let's say in year 2, we feel that this fund is probably not performing well. I should stop the SIP here, and maybe I can start another SIP in fund 5, right? But I am still going to monitor this fund, right? We are not withdrawing all the money. Whatever you have invested so far in 1 year, we are going to keep that money in that fund, but we are just moving the SIP to the next fund. But let's say this fund has not performed even after 3 years or even after 4 years, then probably we can remove this, we can redeem all the amount, and we can split this between other funds. This is what rebalancing means. And probably in year 4, we feel that, probably this fund is also not doing that well. Instead, we can move this fund to another fund. So this is all rebalancing will look like. And I have already given some of the parameters how we do the rebalancing. I mean, this is how we do at Asset Yogi Wealth. We avoid exit load, we avoid all the short-term capital gains tax, and we try to minimize the long-term capital gains tax. So we have to do the cost-benefit analysis before we do any kind of rebalancing. And what we do is that we say that we should have maximum 7 funds in our portfolio at any given point. It doesn't make sense to have 10, 15 mutual funds because then it will be over diversification. And we have seen that, over diversification doesn't make sense. And when should we redeem? We should redeem at the right time. It can be either need-based. What do we mean by need-based? Probably you have reached your goal. Now, probably you want to buy your house. You have been investing for your house for last 10 years, and now you want to make a down payment. So you can redeem that amount and you can invest for your house or for your retirement, whatever that goal is. Or probably there is a better opportunity. Let's say we had a better opportunity here. This fund was not performing well. So what we did was we split it between other mutual funds. Now, how do we build a mutual fund portfolio? We can have a core satellite approach. Core means that we can have a equity mutual fund core, which is going to be our 80%, and this 20% can be our satellite portfolio. These are short-term opportunities. For example, we saw that, the markets were bullish. So in bullish markets, we saw that momentum fund was doing really well, right? So probably we can invest in momentum fund. In bearish market, if a valuation fund is doing much better, then we can switch from momentum fund to value fund. Or maybe we want to have 20% in debt, right? So this can be our satellite portfolio. This is generally a recommended core satellite approach worldwide. This is not invented by me, but this is generally followed by a lot of wealth managers. Mutual funds can also give you income. Not a lot of people are aware about this. Growth, we have already spoken, right? So far, we are talking about long-term wealth building. We are talking about 13% returns and 14% returns and so on. However, if somebody is going towards the retirement age, let's say somebody is 50 plus and he's planning for a retirement in next 5 years, 10 years, and he would want income after that, some income for regular monthly expenses, then that is also possible through mutual funds. Let me give you an example. A lot of people, what they do is they will put their corpus in fixed deposits. So here we have taken an example. Let's say somebody is keeping 1 crore in FD. Then let's say he's getting 6% per annum. So 6% of 1 crore is how much? 12 lakhs per annum. So he can withdraw 50,000 of interest per month. But at the same time, this 1 crore is not growing. After 3 years, this will remain same because you are withdrawing 50,000 every month. But inflation is still going on. What after 5 years, suppose your regular expenses are wanting 60,000 per month. How do you fund this? Then you are going to compromise on your lifestyle. However, with mutual fund, inflation can also be taken care. Let's say in mutual fund, you are getting, I'm just assuming that you are getting 12% returns, right? For easier calculation. So let's say you have invested again 1 crore in mutual fund. So after 1 year, that 1 crore will become 1.05 crores even after you take out some money. You can regularly take out money from mutual funds also. This is called SWP. This is, let me write it here. This is called as systematic withdrawal plan. Withdrawal plan. Every month you can take out money. This will be automatic. This money will automatically come to your account. So what we have done is we have assumed that 7.2% returns, which means on an average per month you are getting 60,000 rupees. So 60,000 into 12 becomes 7.2 lakhs. So 7.2 lakhs you have taken out from 1 crore. But your portfolio is still growing at 5%, right? So 7.2% plus 5% is about 12.2%, which is the assumption that I have taken, that you can assume these kind of returns from mutual funds. So here again, I have taken a conservative estimate that you can safely get 12.2% returns from mutual funds. However, in the past, we have got more than that, right? Now, let's say after 5 years, you need more than 60,000. First of all, please see that this here you are getting more in mutual funds. You are withdrawing 60,000. Here you were withdrawing only 50,000 rupees. And now you are not able to withdraw 60,000 here. Here, even if you want to withdraw 70,000 rupees per month after 5 years, this is possible because your corpus is higher here. And this corpus can fund your inflation also. So this is the beauty about mutual funds, that you can fund your retirement and you can also have monthly income. And a lot of people were asking about the passive income in the questions also. So this is also a good way of having a passive income through mutual funds. Now, next comes is stock model portfolio. So I will continue with this only if the people want it here. Otherwise, I can stop here and take some questions. Amresh ji, how is the mood?
So there are few questions in the chat box.
Yeah.
Thank you so much. Excellent presentation so much. So I request you can take up some question now, and depending upon the mood, we can take it further.
Yeah.
So I'll read out one question. Is Raj Tandale? Is there any way to reclaim long and short-term capital gain tax?
Yeah, of course. I mean, reclaim as in you have paid higher tax. That is what you mean?
So Raj, if you are around, then you can unmute yourself and you can ask directly.
Then in that case, what you have to do is you have to file your revised ITR with the revised capital gains, and whatever your actual returns are, actual capital gains are, that you can file.
Okay.
Okay, thank you, sir.
Yeah. And then somebody is asking, as we invest in mutual fund, then the portfolio will be managed by fund manager. So is it possible to check which stocks are under holding and more insights of portfolio? Obviously, this is all available in the information memorandum, whatever stocks they are investing in. And there are a lot of portals these days from which you can see which stocks they are investing in.
Okay. Now
Somebody is asking, Nimish Pradhanji is asking about...
Pradhan, you want to unmute yourself and ask directly to our host, to our presenter?
Yes. I have a few things. This is my experience, and Atul, excellent show. What you have done so far, but I have also been in this. Yeah, Mukul. Yeah, sorry. Yeah, of course, you are my junior, so my heart always will go out to you. And the thing is, you mentioned about insurance. Now, first, I think we're looking at an audience, let's say, who's 20 now, who's a cadet, or even a third mate. We're looking at that basically. So basically, you can take a medical insurance first, and then, increasing the sum assured. Same goes with life. And
Yes.
because, medical costs are going to kill.
Yes.
And they kill. Going to a doctor and a Jyotish is the same.
Yeah.
Please, emphasize on that. What could be the incremental which you think, in your opinion, just offhand, nothing really great about it. Also, you mentioned about real estate. Fine, I really don't think it's a good idea. I've lost heavily in real estate. I wish
Yeah.
I'd put that money in stocks or mutual fund. Um, instead, you could just go on rental, which is the case now. And
Yeah.
then of course, which would be much easier. Maybe you can throw a little bit light on that. You mentioned about the gold ETS. You know what? Basically, you have to see. When the guy comes ashore, you've spoken large about SIPs also, but when the
Yeah.
guy comes ashore, he has no earning yet.
Yeah. I
So
understand.
really, his SIP, he goes on a 6 months contract as a third mate. I mean, then he cuts his SIP.
Hmm.
So that is that basically. Then please speak on NPS, because I remember when I joined at sea, and a couple of my friends did continue, from cadetship till they retired. They still continued with the same company, Indian company. We had those leave wages, and then of course then we had a provident fund and a gratuity and all that, EPF, pension scheme. So when they retired, they had a big sum of money, but today it's contract. And what I see on board is that most of the gang परेशान है यार कि साला next contract कभी मिलेगा, पैसा नहीं है, this that. So the NPS, now linking this with NPS would help. Plus there is a tax benefit also for it to come. And the one thing which you said of repayment of home loan and the timeline you gave,
Hmm.
I have also have a home loan. And
Yeah.
I'll tell you one thing, that maybe the way the home loans, the banks are the biggest sharks in the world today. Even doctor is not bigger shark. First, they
Yeah.
have to take out the interest. So after 10 years, I don't think, 20-year loan, it's a big thing to pay out the home loan. Because you see, your SIP to theek hai, mutual fund say in 10 years, it goes 10 times there roughly. Just a rough term, which is my experience. Whereas, say, if he has invested, say, with 20 lakhs in that, and he's got 20 lakhs to pay back, I mean, that
Yeah.
20 lakhs is going to be 20 lakhs, and adjusted inflation in another 10 years, that 20 lakhs is going to be peanuts. Whereas that 20 lakhs of which is going to pay out would be 2 crores after 10 years,
Yeah.
So this is where was a bit of a disagreement with you. So
Sorry,
these are
I
basically the
didn't
points
But,
understand.
churning.
but
What
he
you
has
You said
not
very well.
he has not said to close the loan. He has just shared an example that
Yeah.
you have two options, that you can remain debt free also, and your fund your small SIP can even repay your loan if you want. But he has not suggested to repay that.
Okay.
No, no,
I
no.
think I can go
No,
one
no,
by
no,
one.
no, no. I don't think we should suggest to these guys to repay the loan, Don't.
Nobody has
That is what
suggested.
I would
Anyway,
say. If he's
thank
still
you,
earning.
Saab. I think we will let Mukul speak now.
Okay. Yeah. So the thing is, let me go one by one. So when you are talking about insurance, right? So what can be the sum assured? The thing is that there are a lot of thumb rules, right? So suppose your lifestyle calls for 1 lakh per month, right? So you should be funding your family for next 20 years, right? So which becomes 20 years of your expenses. That can be your sum assured. So today, if you feel that 1 crore is enough for me, then that can be your sum assured. Tomorrow, let's say after 5 years, you have to judge again that what are my expenses now? Do I have to increase my sum assured? Then accordingly, you can increase your sum assured, and obviously you will have to pay the premium. But at the same time, like I said earlier, that you have to take term insurance, because don't mix insurance with investments, right? That is number one. I hope insurance part is clear here. Second is lump sum versus SIP, and I think sir had mentioned that a lot of people are sailing, and they have to stop the SIP whenever they are coming back because it is not continuous. So the thing is, you have to plan annually and not monthly, right? This is particular for mariners. You have to plan annually. So what is your annual income? Never say that you have a monthly income. You don't have a monthly income. You have an annual income, right? So suppose you are earning, say if somebody is earning, I'm just saying, I don't know what are the earning levels right now. Let's say somebody is earning 2 lakhs per month, but he's earning only for 6 months. That means the earning is only 12 lakhs, right? So he cannot plan for maybe more than 50,000 of SIP, right? So he has to make sure whenever he's on board, he has to make sure that there is sufficient amount for next 6 months when he's not going to be on shore, right? He has to make sure that there is sufficient amount for the SIPs. The second way of investing is lump sum investing. So whenever you are coming ashore, I mean, this is very personal. And as we say that, personal finance is very personal. Everybody will have a different view and a different way of managing. And a lot of people, come to us as professionals also that, I want this. We have few suggestions to make, but at the same time, not everybody is comfortable with SIP, not everybody is comfortable with lump sum, right? These are two ways of investing and both are right because you have to manage your finances. So if somebody, let's say, comes to the shore and he wants to do a lump sum investing, that is also possible. Let's say you have saved 4-5 lakhs and you have this extra amount, you can put that in mutual funds or stocks, whatever you are comfortable with. So that is another way of investing. However, I feel that SIP is a better way of investing because your cost also averages out. And I have tested this multiple times over last 25-30 years. SIPs win 95% of the times. Lump sum will win 5% of the times whenever there is a recession in the economy. So that was the answer to the second question. I hope I have answered so far. Third part is NPS. In fact, I have made multiple videos on NPS. This is a more detailed topic. It will call for, lot of nuances. So I would urge people to watch my NPS videos. However, I have certain takes on NPS. You have to remember that whenever you are investing in NPS, that portion is going for long term and it is only a retirement fund. You will not have liquidity. So if there is an emergency in your family, you will not be able to take out that money, right? So you have to understand that product. Liquidity is a big challenge with NPS. In fact, I am in touch with a couple of promoters also who are managing these kind of apps which are making people invest in NPS. And this guy also doesn't have an answer to this problem, right? There is a app called Pension Box. I know the founder. So this guy also understands, yes, this is a drawback of NPS. So you have to understand, but at the same time, if you still want to invest, you are free to do that. But there is another way. You can keep investing in mutual funds and you can get better returns and you will have a better corpus at the end of your retirement, but you need good discipline. So there are pros and cons, right? With mutual funds, generally we see that, a lot of people are not very consistent and they don't follow the discipline. Hence, a lot of people should seek professional help because that professional will tell you that, okay, this is not the right time to take out money because you just want to take out money because you are panicking, right? Behavioral finance can increase your returns by almost 1.5%. 1.5%. This is a study done by Vanguard in USA in the long run. And generally, experts can help you with that. Fourth question was about the home loan versus SIP. See, this is a very debatable question. I am in this profession for quite a long time and I keep interacting with a lot of subscribers, my friends. It is like, should you be renting your house? Should you be buying your house? Right? It is that kind of debate. And there is no clear answer to that. If I'm going to say that you should not be buying your house, half of the crowd here will be against me. And Nimish sir was saying that, no, you should not be buying your house. You should be, renting your house. This is very beautifully explained in Psychology of Money, right? There is a book and he says that the author himself has bought his house. He says that you treat your house as a consumption item. This is not an investment. We have to clearly make a distinction here. It's a consumption item. See, today I can say that I should not be wearing this sweater. I should be wearing a sweater half the money. If this sweater is costing 3,000 rupees, I should be investing 1,500 rupees and wearing 1,500 rupees. This is my personal choice. I want to wear this. So hence it is somebody's personal choice. Somebody wants to buy a house or not. Similarly, it becomes a personal choice. Somebody wants to pay the home loan or not, because people also have psychological biases that, okay, I want to remain debt free. This gives you peace. If you are peaceful, you can perform better in your job, isn't it? If you are performing better in your job, you can earn better. So there are pros and cons. I get it. I mean, I am also not investing heavily in real estate now. I also understand what are the returns in real estate. I have burnt my hands in the past, and hence I also want to educate a lot of people. But at the same time, I am also not telling blindly that you should not pay off your loan, you should not buy your house. No, that is a goal, a dream for a lot of people, and I get it. I get it. Right?
Thank you, Mukul. Thank you so
These are the
much.
answers for the questions that Nimish sir had asked, and I can take other questions.
Thank you. Okay. Anyone, if you want to ask any question, just raise your hand and we will request you to
And
unmute.
meanwhile, I can see, I think my colleague has also shared a link. If somebody is seeking help, because there are a lot of mutual funds and stocks these days, and allocation, rebalancing, how do we get it? You know, which funds to invest in. If you are seeking a professional help, you can book a call with us. You can talk to our relationship managers, and we will be happy to help. Okay, so there is a link. You can book your call and have a one-to-one conversation also.
Thank you. Thank you. There is a question. There is Mr. Faria is saying NRE account holders cannot open NPS as per bank visit. Fair enough. If that is the regulation, that is the regulation.
Yeah, see, regulations, we can't do much.
That you have to abide by that regulation. Fair enough. Do you recommend regular or direct MF from Captain Sanjay Gupta? Maybe you can unmute yourself and ask Captain Sanjay.
Yeah, I can answer that. I mean, of course, you can unmute if there are multiple questions, but let me answer. Yes, we suggest regular mutual funds because that is how we earn. And let me be very transparent here. We get about 0.6 to 0.7% on an average from the AUM company, from the AMC company, the mutual fund company. We don't charge the clients directly, but the way it works is that we earn the alpha for the clients, right? So if you are making, let's say, 3-4% extra, then 0.6 0.7% will not look much in front of that, right? So our mutual funds and stocks have beaten. In fact, I don't know, I have not shared this. I can share this slide also with you where we have shown our performance. So let me show you. There is a slide here. This is the stocks performance. Let me just share that window. Yeah. So this is the performance of our stock portfolio from the period March 2024 to October 2025. So we were recommending one stock per month during that time, and we have taken apple to apple comparison of Nifty 50 and Nifty 500 during that time with our portfolio. During that 1.5 years, our portfolio had given about 18% of returns, whereas Nifty 50 and Nifty 500 had given these returns. So we have clearly beaten the market by more than 8%. So this is the performance of our stocks and mutual funds also. The mutual funds portfolio that we are giving, it is a very, very diversified portfolio. I mean, we do the proper correlation, we run the simulation models, and those funds have beaten the market again. So if I talk about a portfolio level, those funds have also beaten the market by easily 3 to 4% in last 5 to 10 years. And every year, if you are beating the market by 3%, sorry, then in next 20 years, your corpus can double because of that extra 3%. That is the kind of difference that you can make.
Okay. If there is no question, Mukul, how many more slides you have to present?
Let me see. I think there will be another 10, 12 slides.
Yeah, I request if you can just complete your slide presentation so that a majority of the audience, even if they watch later, they can have a glimpse of it.
Okay, there are no more questions, right?
As of now, no.
Okay.
And I think 13, 14 questions which I have forwarded to you has already been covered in your presentation.
Yeah. Okay. Let me just finish off those slides also.
Mr. Faria, we will take this question after the presentation.
Okay. So I have spoken about mutual funds extensively. Now let me touch upon stocks also. How do you build a stock model portfolio? So obviously, again, there are 3 steps. First, you will have to screen and shortlist. So there are more than 6,000 listed companies here. So you have to first screen and shortlist. What we do is we generally have a 50 to 60 watch list in our portfolio always, right? Then out of this 50 to 60 stocks, then you have to come up with 10 to 15 stocks, right? So once you have come up with 10 to 15 stocks for your portfolio, which will give good diversification, then you have to allocate basically 1, 2, 3, 4, what percentage in what stock. That means allocation. This can be based on a simulation model as we do, but for retail investors, this can be based on the valuations or what kind of growth a stock is showing, what kind of conviction you have. So you can also have a qualitative analysis yourself, and then you can allocate accordingly. Third is obviously rebalancing. If you have invested in 15 stocks, maybe you want to exit 3 stocks after 1 year, and you want to add maybe 2 more stocks in your portfolio. That becomes your rebalancing. Now, slightly in more detail about this process. Out of this 6,000 stocks, how do you identify 50 to 60 stocks, right? That calls for a lot of analysis. So you have to do financial statement analysis, you have to do valuation analysis, ratio analysis, qualitative analysis, what are the competitors doing, industry analysis, macroeconomic analysis, technical analysis. You also have to take care of the diversification in your stock portfolio. So out of those 6,000 stocks, you have to complete your research and analysis, and finally you will come up with your 10 to 15 stocks. This is the example of a portfolio allocation. For example, if you have 15 stocks in your portfolio, this is an example of how many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. 11 stocks, right? So let's say this is the original portfolio that you had started with, and this is the allocation that you had made based on your understanding of the valuations and the growth of the stocks, right? Let's say you had made these allocations. Let's say after 1 year, there is a problem with one of your stocks. In fact, this happened with one of our stocks. There was an insurance stock and the data leaked. The data of the customers leaked. So this is a problem with the company. How can the data get leaked? That means there were not sufficient cyber checks that were happening. So this is a problem. And let's say you want to sell this stock. This is a fundamental trigger. Now, you sell this stock, you can introduce one more stock in your portfolio. This is rebalancing. Similarly, this can happen with multiple stocks, or if it may not happen at all, because if all your stocks are doing well, then you don't really have to rebalance also. But however, we have seen that 10 to 15% churn is a healthy churn in your portfolio annually. So this is what we do, what we have experienced in the past. Not necessarily that we have to do every year, but this is what has happened in the past with our portfolio. Now, mutual fund investing can be obviously overwhelming because there are more than 1,800 funds to choose from. There are a lot of equity funds, debt funds, hybrid funds, passive funds. Similarly, in stock investing can be overwhelming because there are more than 6,000 stocks to choose from, and then you have to do so much of analysis every month or every year. So which is generally not possible for a professional who is focusing on his career or his active income. Now, this is where experts can help, right? So DIY, for let's say if somebody is a DIY investor, do it yourself, who is doing everything by himself, how is he generally investing? He is either investing on some emotional bias. Maybe if somebody is working in shipping, he will probably know this industry better. He will blindly buy a shipping company. But that shipping company has not grown in last 5 years, 10 years, and probably is not going to grow in next 5 years also. So that is not the right way of investing. A lot of people, will these days invest on hearsay. I mean, just by looking at some social media post or by looking at some CNBC or Z, some interview. So that is also not the right way. So people are not generally researching stocks or mutual funds, and they are just investing on hearsay or minimal research. However, when you are investing with the help of an expert, it is all research backed. And it is shown with data. This is the data of Axis Mutual Fund. They have seen that in last 20 years, DIY investors have made only 13.8% returns on an average CAGR. This is CAGR, annual returns. Whereas if somebody was investing with the help of an expert, the returns were in the range of 15.2 to 19%. So even if we take average, this comes out to about 17.1%, and this difference is huge. So this is about how much? 3.3%. So this 3.3% can make a huge difference in next 10 years, 20 years. Long-term investors, I mean, these generally DIY investors are not long-term investors. For more than people who are investing for more than 5 years are only 7.7% people. This is again real data by Amphi and Crystal Research. Whereas if somebody is investing with the help of an expert, this data is 21.2%. 21.2% people are investing for more than 5 years. Portfolio review here is nil or random. This is timely and market based. So definitely an expert can add a lot of value. How we can add value, I will just take 5 minutes and then we can close this presentation. So obviously I have spoken about goal-based planning. So whenever somebody is talking to us, we are properly understanding their goals and we are doing the goal-based planning for them. We have curated mutual fund portfolios. We are also doing the rebalancing regularly. We are watching the parameters every month for all the mutual funds. We have model stock portfolio also, and we do rebalancing for our stock portfolio as well. This is the strategy that we follow. You can also follow this strategy even if you are doing this yourself. So what we suggest is that you can invest 70% of your funds in mutual funds and 30% in stocks. So this is where you can generate alpha. I had spoken about alpha, right? So our target in mutual funds is that we want to generate 2 to 3% returns over and above Nifty 50 and Nifty 500 index. So Nifty 500 is a very broad index that follows the entire market, and Nifty 50 is a large cap index, right? It just follows the top 50 companies, but we follow both and we try to beat both the indexes by 2 to 3% every year. In stocks, our target is slightly higher. We are targeting more than 4% returns over and above these indexes. So once you have this combined strategy, and let's say you are making 3 to 4% extra every year, more than the market, this can become a huge amount in the future. Now, how do you do this? How do you really do this combination of mutual funds and stocks, even if you are doing it by yourself? So a good way of doing it is that, you can do monthly SIPs. You can invest, let's say, monthly 20,000 rupees, and let's say you have lump sum amount, you are coming back from selling, you have some extra amount, again you can invest in mutual funds based on the market conditions. And let's say at the end of the year you also want some stock exposure, so you have some 50,000 rupees extra in the 10th month, so you can invest 50,000 rupees here in stocks. So this is how it can actually look like. So I have already shown these highlights of our past returns, and this is what we have done so far. So why should you trust us? So we have some points for you. So we are a 4 million plus strong community across social media. We are SEBI registered and compliant. We are also AMFI registered. We have an independent research driven approach. Nobody is sponsoring our research. We want to have a win-win situation with the clients, because we want to have long-term clients for us, lifetime clients for us, to be very precise. And we have a proven brand legacy with Asset Yogi, which we want to continue with our Asset Yogi Wealth also. So that's about it. And if any of you wants to book a call, this is the link. This is also available in the chat box. This is the WhatsApp number. You can store this number. And even if you are on sailing, you are coming back, or you want to invest right away, you can just send a message. You can have a one-to-one call with us also. I hope I have been transparent enough, and I hope I have added value and it was worth your time.
Thank you so much. Thank you so much, Mukulji. And I think it is definitely, it has been very helpful. And I'm sure all of us have benefited with your own experience that you have shared with us. I'll just take 5 more minutes for question answers before we go to the next segment. Mike, you want to unmute yourself and you can ask your question?
Somebody had asked, what are momentum funds? So momentum funds are those funds which are investing in those stocks which are showing lot of momentum in the market right now. This is generally based on technical analysis. So whenever a fund manager is applying technical analysis, he's actually judging the price movement. He's not going by the fundamentals of the company. If a stock is showing price momentum, he's going to invest. So there is a lot of churn in the stocks. In momentum funds, fund manager is buying, selling every day, every month. So there is a lot of churn happening, right? But because of that price momentum in the bullish market, these momentum funds can generate slightly higher returns, but you have to be very cautious. This should not be part of your strategic portfolio, right? As I had mentioned earlier. So strategic portfolio should be consisted of long-term growth. So your 70 to 80% of your portfolio, mutual fund portfolio, should be strategic in nature, which should be long-term. However, for tactical approach, you can have these kind of momentum funds. And if you are seeking value fund for a particular time period, then you can have those tactical funds in your portfolio.
Okay. Anyone else had any question? I'll just check if anybody has any question. Regarding presentation, Amit, you have this presentation available on YouTube. Seller Today has been live telecasting it, so you can go through this presentation on the YouTube. Otherwise, there's a link here in the chat box. You can go through that as well. There is a link Garima has shared here, which is for, I think, you can book a call and you can get through your presentation. So that can be done. Anyone else? Any questions? Okay. So if no question, then I just want to add a little reason behind today's seminar on personal finance. And I'm sure this is going to be a masterclass available on Seller Today YouTube. Mukul is also recording it. Probably he will share it if needed in the group. Otherwise, you have opportunity to watch on Seller Today. Guys, I have been listening this request for last 1.5 years, including Captain Pradhan has requested so many times. So many of you have been sending me the messages. Even today, I have received few messages from the ship. Those the people are selling, they want to see it later. Of course, it is available. I'll tell you, Mukul, my story, and I have posted in my LinkedIn also. I have sailed till 2013.
Yeah.
And in 2013, when I left sailing, I joined MMD, Mercantile Marine Department. That was my first source job with Government of India. And till I was sailing, the only investment I have done is buying land in my village. And you have enough, you have explained it enough. The kiosk, the amount of time, hurdles it takes to maintain or to manage those lands. And especially I am from Bihar. lot of this survey, that survey, some or other thing is going on.
Yes,
So,
yes.
and you are not there on the field, you are not there or there on the ground. So you have to trust, you have to just, I mean, you have to accept whatever it is going on. Nothing is in your control. So the first thing that I would say that today's session has given you, that you will have a control on your data, your money, you should be able to control your things. You should not owe something which is not in your control. So that is what is first learning for me. And I have done that mistakes. The other thing I'll tell you, I was so financially illiterate and there was not much available data as well. And probably I was not curious enough to find. I mean, I'm sure it was available at that time, but I was not curious enough to find out for myself. And I started my PPF only when I joined my first sole job, for me and for my family. And my real, I would say, saving, learning with finance started from 14, 15 onwards, when I moved to Mumbai in 15. I don't want this to happen to other seafarers. The mistakes, I'm not saying that everybody has done that mistake, but I interact with most of, at least my peer group, who has made a similar mistake, buying land in villages. Now they have moved to Mumbai, Delhi, NCR, and all that region, and they are unable to even track those lands. So at least we have an opportunity wherein people like Mukul, who has a seafarer's background and also more than almost 2 decades of experience in teaching finance. So who else can be better person to guide us in this journey, if at all we want to take it on a professional level? You have all the liberty to reach out to Mukul. He is available through YouTube. The details of WhatsApp is given. And most importantly, I must thank Mukul for his overwhelming support. The moment I reached out to him, we were not knowing each other. And how this started, Mukul, I met Mr. Pradhan in one of the marriage, Captain Pandey's Pentagon director's daughter's marriage was there. And he was behind me and we never met again. Captain Pradhan and I was meeting for the first time. And he said, hey, you have been telling me to arrange this kind of seminar. Sorry, I'm not able to get somebody. So then I said, I have found somebody in LinkedIn who has Chanakya experience. He's from Chanakya. And he's also very well known in YouTube. I have seen his YouTube and I find him very connecting, and I watch his thing. I will try to send him a friend request and I will try to approach him. That is when I sent you the LinkedIn friend request. You were kind enough to accept my friend request, and then we exchanged number and then we interacted. This session was supposed to happen last month, but for some reason people were preferring to go on leave end of the month because of the New Year thing. And this program we always do the last Friday of the month. So thank you again, Mukul, for all that what you have done today, and I'm sure this is going to help a lot of people. Today we have around, it started with 48, 49. Now I think it's around 24. The session was supposed to be of 1.5 hours. Now we are almost touching 2 hours. Before matching much delay, I'll request now Pratik, if you want to now unmute yourself and give a Thanksgiving on behalf of Seafarers Global to
you had asked some question, Amreshji. I said I will answer later. What was that question?
So it is basically what we do is this is basically Maritime Leader Talk series, okay, wherein we invite maritime people who had some experience with maritime, but they are leader in different fields. They could be in maritime, they could be in some other things. So like you had a maritime experience, but you are now leader in financial literacy. You are into the different field. So you have 7 years in shipping. Like if I see 2000, you started Chanakya, till 2006-7, you were in shipping. So what was that learning? Why did you choose to leave sailing and join ashore? We all move, but generally we live in the shipping domain. Koi manning join karta hai, koi training join karta hai. You choose a different path. And you are making a big name in that part as well. So your leadership lessons, because nowadays present generation I see, they are having entrepreneur mindset. So they will connect with you more because we are setting an example on a traditional path, which has been run by 90% of the seafarers. You are probably among 10% of the seafarers who have sailing experience, and you have moved out on a different domain and you have made name for them yourself. So your leadership lessons for all those people who are future leaders for maritime, or who wants present generation also, who wants to take an attempt in entrepreneurship journey. Whatever you would like to say, Mukul.
So I think there are two parts to your question. I will answer one by one. First is why I left shipping and pursued the path that I am currently pursuing. So see, first of all, I have deep respect for shipping, and I am so deeply connected with the maritime fraternity even now because of our alumni network. I keep going to Dresha events. But the thing is that when I started investing, I had started my investing journey way back in 2004-5 itself. I had started earning in 2003, right? So 2004 or 5, I don't remember the exact month when I started, but I had started my mutual fund investment journey in 2004 or 5. And that is when I got really drawn to the world of finance, right? So I really wanted to learn finance, and I was also drawn to the business side of shipping and how this whole business works. So that is when I decided, if I have to really learn, then the only way those days used to be you do an MBA, right? So I did the MBA, and then I eventually moved to the finance domain. I was working in L&T earlier, Larsen and Toubro. I was in Chennai earlier. So that's how the switch happened. And I used to learn a lot about stocks, read a lot about mutual funds. So read a lot about the markets of USA, India. I used to follow almost all the blogs in 2008-9, and then started my stock investment journey also in 2009 itself. So that was when the seed of the entrepreneurship probably was sown, right? And eventually in 2013-14, I felt that I should be contributing. If I have learned, then I should be sharing this with the world. And that is when I started my blog called assetyogi.com in 2014. And from then I am on my own, and I started my YouTube channel in 2017. And that's how it is. And I hope that, sometimes people when ask about, what are the leadership lessons that you have, I find it, very funny when somebody is, let's say, joining a ship for the first time. And when we used to get these kind of questions and we were just cadets, we could not relate to leadership at all. I am just doing menial jobs, and I'm just following the chief officer. So leadership was absolutely not making sense at all. Who am I leading? Right? But eventually, as you grow, you get your answer. So for me, the answer was that there is a difference between individual leadership and team leadership. You don't have to necessarily lead a team always. There is also a concept of individual leadership. I mean, Arijit Singh has, just now spoken that he's quitting playback singing, but is he not a leader? He is leader because he has inspired so many people. He's already leading, right? So if somebody is working in his job and he's giving his excellence and he's giving all what he has to offer, and if he's following a pursuit of excellence and he wants to really inspire people, even if somebody is a cadet or is a third officer, a fourth engineer, fifth engineer, he can also do his job better. And once he will be better at his job, he will be probably taking slightly more initiatives. I still remember there used to be one Captain Naresh in Searland those days. He used to make navigation softwares on Excel those days. I was really inspired by that, because he's taking initiatives. If I am getting inspired, that means he's a leader, right? So I took those lessons from maritime industry and followed in my own domain. I still make a lot of calculators just out of interest, right? So, and we make them available for free because we want to add a lot of value to people. So I think that is what leadership is all about, pursuing excellence and taking initiatives.
Thank you so much. I can see Captain Vikesh Chawla, very senior mentor. Captain Pradhan, of course, he has interacted with you, and so many of senior mentors have also joined. Thank you so much, everyone, for joining. Captain Vikesh, you want to say something, sir?
No, nothing. I heard it. Then I had a power breakdown. So then I had to go off. Okay. So I had sent a message also to Saabji कि भाई हम तो अभी 68 हो गए हैं. You must have seen that thing because most of our kids are foreign citizens and settled abroad. how do we handle this wealth for them now?
Yeah, of course. I mean, if there is a personal query, if there is a personal thing, we are ready to help. And if somebody wants to manage his wealth on his own, we have a lot of resources on our YouTube channel. And I mean, these are just free for use for anybody.
Parosi hai sir, he's in Delhi and you are also in Delhi only. So you are just probably one metro station away here and there.
That's correct. Yeah.
All right. Sir lives in Gurgaon. So I think it's not very
Not very far, not very far. I live in Dwarka.
Okay. So thank you so much, everyone. And again, thank you so much, Mukulji. And I now hand over this to Pratik, who is joining from Dubai. He is also our very closely working with me on this kind of webinar. So over to you, Pratik.
Thank you, sir. Thank you very much. Thank you, Mukulji, for the wonderful session. I'm also a Chanakya cadet. I passed from Chanakya in 2006. Nice to see that people from Chanakya are getting into financial fields also, because till now I have only met with the people, those who have gone into the civil services. So definitely it's a great honor to meet you and hear you. Anyways, as we are concluding this today's session, I would like to thank to everyone, all the participants, and everyone who has given their thoughtful questions, and especially to Mukul sir, who has answered most of the questions to the people. And your engagement reflects how important financial clarity is for those of us working in the maritime industry, where long contracts, time away from home, and financial planning goes hand in hand. Basically, the purpose of this webinar was simple: to help you view money not as a source of uncertainty, but as a tool of stability, both at sea and ashore. In our profession, financial success is not about how much we earn during a contract, but how wisely we plan and protect and manage those earnings over the time. Once again, thank you all for being a part of this today's session. Wishing you all safe sailing, steady plans, and long-term financial well-being to everyone whosoever is right on sailing and ashore. Thank you, Mukulji. Thanks a lot. Thank you, Amrish, for arranging such a wonderful session.
Thank you. And I must give credit to Captain Nimish Pradhan, who is joined from ship. He is sailing, but he was behind me to have this kind of session. He has requested that we should arrange quarterly. Let's hope that we can arrange, sir. It will depend, sir, how much participation we get. We don't want this, our time. We are all working. Mukul is also working. He has taken 2 hours. It should be beneficial to all. And if we get a lot of participation from our Seafarers community, definitely I will invite Mukul and probably similar speaker from the different domain. So thank you again, Mukulji. And last word, if anything you want to say before we conclude this.
No, in fact, if we have sufficient interest for any future sessions, and if people have questions, I will be glad to answer. And if you want to organize any physical event also in Delhi, Mumbai, anytime, and of course, if there is a sufficient participation, then we can have those sessions as well.
Surely. That I will definitely plan, and we will definitely invite you for that, and we look forward to having you here. There are 2 primary reasons. One is, at such young age, you have created, 4 million plus is not a big, it's not a small amount, it's a big number. And you are from Chanakya, you are from our fraternity, and you're doing so great. So definitely it will be a proud moment for all of us to invite you and have these sessions. And thank you everyone for joining. Mentees, mentors available on Sailor today. Captain Nangia Saab, thank you very much, owner of Sailor today, for always participating in this kind of webinar and doing a lot of hard work from background. So thank you so much for live telecasting it. And everyone, Mukul is available on LinkedIn. I don't think he's very active because I sent him 2-3 messages, replying very seldomly, but probably he's more active in YouTube or other location. He has shared WhatsApp number, whoever wants to join. It is, again, I said, it's a personal finance, so it should be your personal choices. We are only organizing as a educational thing, and Mukul has been very kind enough to share all the expertise that he can share with all of us. So thank you so much, Mukul. Thank you, everyone.
Thank you.
We will disconnect the call now. So thank you so much. Bye-bye.
Thank you.